Welcome to another episode of the Hustle Harder Show. I'm the host, James Gaskin, and I am honored to be sitting here today with our special guest, Renovo Chief Credit Officer, Darren Weaver, aka the Dream Weaver. Today we're sitting here in December of 2024, and we thought it would be fun to take a look back at, kind of what we saw in 2024, some of the challenges our investor clients had to deal with, maybe how they navigated some of those challenges, and then looking ahead at 2025, what are some of the themes that Darren is seeing from his perspective as the Chief Credit Officer at a national lender, and some of the things that, our clients should be thinking about as they're going into next year and planning their business. So that's the theme here, and excited to have Darren. Darren, I know you work directly with, our lending team.
Yep.
To facilitate, all the loans that we're doing for our clients, and you're kind of on the front lines of seeing what's happening in the local markets that we serve. And so I thought you would be the best resource for us to talk to about, kind of what that looks like. And I know you look at everything from a credit and risk perspective, which of course our clients are also doing in their own businesses.
Mm-hmm.
And, want to kind of dive in a little bit on some of those things that you've observed and kind of what we're thinking about. So let's dig in. First of all, let's get a self introduction from you.
Sure.
Tell the audience a little bit about who you are and how you got here and what your role at Renovo is.
So first of all, thanks for having me onto the show, James. I'm so excited. Forgot my Hustle Harder Show mug, but if I had it, I'd have it proudly here in the recording. But I'm Darren Weaver. For those of you who don't know me, I'm the Chief Credit Officer at Renovo. So, my primary function is to manage risk within the organization, which with the loans that we do, the portfolio that we build, and really work, hand to hand with our loan officers that are out in the local markets that we serve, and helping them structure loans, think about risk and what they do, and how to better serve our entire community, from you guys down at the customer level, all through stakeholders that we have here at Renovo.
Love it. That's a great introduction. And, you've been an awesome addition to the team here, and I think has really helped us, scale to the extent we've been able to do that. And so appreciate all the effort. I know, it's a difficult job that you have playing, between the lending team and trying to get deals done, but also managing risk for Renovo. And you do an awesome job of that.
Thank you.
And I think one of the things that makes Renovo a little bit special is that we do have a really collaborative environment between risk and credit and the lending side and the sales aspect of the business, which is super important if you're going to build a lender that's actually going to survive, over a long period of time.
Absolutely. I mean, just a quick comment on that. I've worked at many different lenders. I've come to know lots of lenders, been on the buy side and the lending side. And it's really critical for your risk people to work hand in hand with the sales organization. And typically when there's a wall in between those organizations, it can lend to bad customer experiences, not understanding what our clients are going through in their local markets. And look, risk management and credit and structuring loans is not black and white. It's not yes and no. It's a spectrum. And within that spectrum, within each local market, you have different pros and cons, and you have to kind of look at each market individually and kind of balance that out with what the needs of the customer are with the needs of the company as well.
Absolutely. And I think that, and I appreciate you speaking on that, because I think the lending culture and the credit culture that we have is a little bit unique. I do think, especially, we are in the non-bank lending sector, right? But I think, if you look at the entire kind of real estate lending, the spectrum of lenders in that world, of course, you have community banks and large banks, and you tend to see a pretty adversarial relationship between credit and sales. And I think, we have taken a different approach, which I think does lead to a much better customer experience. And I think, the deals that makes sense, but hey, if we did it a little bit differently, or if we work with our customer to think about the deal a little differently, maybe we can structure something that's not only a better risk for Renovo, but more importantly, it's a better risk for our client, right? And helping them navigate that, I think, is an incredibly important part of what we do. And because we do take a very hands-on relationship approach with the client, I think that's something that we're in a great position to do for our customer. But that all aside, let's dive in on 2024 a little bit. It was a big year. There was a lot of things that happened in 2024. Some things that people were expecting were going to happen that didn't happen, right? And I think those all amounted to challenges that our customer base had to navigate. Obviously, Renovo is a local lender in the markets that we serve. We currently serve on a local level, local basis, about 32 markets or so. You can probably add a few more in there that are
Coming
tangential.
on the way.
Yeah, well, and that too. But we look at things in a very local way. Talk to me about, kind of what you observed from your seat in terms of, the market and some of the things that our clients had to navigate in 24.
Sure. So I guess where I'll start is, 2023. That was a period of time where, a lot of clients, a lot of folks around the country were dealing with price slipping. There was that period of kind of intense rate ratcheting up and kind of a reaction on the pricing side to slip down. I think once that kind of worked its way through the system going into 2024, I think a lot of folks, not only in our space, but in general, were kind of rationalizing real price ramifications. So when people talk about inflation, for example, it's a rate. And the fact that the rate was going down was something in 2024, especially early on, watching CPI kind of trail down. I think a lot of folks were coming to the realization that, wait a second, the real prices are here now, right? And so a lot of our clients had to absorb a lot of that cost, and had to kind of figure out ways in which they can source materials, source supplies in a way that was advantageous for their project. Because, during that whole period of time as well, and that run up, obviously rates kind of tagged along with that general trend, which is also a burden on the client, right? So I think in 2024, there was kind of a breath of where are we, and trying to kind of figure that out. Maybe something we'll talk about within 2024 and in 2025 is a rate environment. What do we think will happen there? But you had a weird dichotomy a little bit in 2024 is, rates were, after the run up, it's kind of been lingering a little bit, right? And the kind of dip we saw in home prices has come back up again. It's now slowly coming up. Most markets have year over year home price appreciation. And so it's kind of, I think 2024 was marked by a trend of realization of where we are. I think one thing I've noticed, within our own portfolio and within the industry, which I think is very wise, is I think a lot of market participants became more focused on blocking and tackling, simplifying, whereas 2022, 2023 had more Hail Marys, right? Luxury ground up construction builds, kind of larger projects in general, irrespective of property type or product type. So, things like average loan sizes coming down, average project size coming down, I think was something that the industry as a whole kind of noticed. And I think that's very wise. I think a lot of really institutional investors that we serve and clients really focused on, what they do really well in 2024. And that's kind of come through.
Yeah, kind of coming back to basics a little bit.
Basics.
Yeah, totally. I think that's right. And one of the things I feel like, if we rewind a year, right, last year around this time, I think a lot of investors were expressing a lot of optimism that we would get some, potentially material relief in interest rates as a whole.
Yep.
That did not really play out. right? And I know our customers are in the business of taking risk, and these projects take time. So you're forecasting kind of where you think things will be, especially for those buy and hold or fix and hold customers that were planning on refinancing into a rental loan.
Yep.
But certainly anybody selling into the consumer market probably expected that rates would be a little lower than where they are today.
Yep.
Talk to me about that a little bit, and how did some of our customers kind of navigate that? Because we didn't see rates necessarily tick up a ton, but it certainly didn't go in the direction that I think a lot of people thought.
Yeah, that's right. I mean, I think, it's natural. We look at the news, we look at the Wall Street Journal, we turn on CNBC. What are they talking about? They're talking about short-term lending rates, the Fed funds rate. It's the cornerstone of all interest rates, which is partially true and partially not true, right? When you look at 30-year mortgage rates that you would get, to buy your first home, or that instrument is more tethered to longer term parts of the curve. So 10-year treasuries, they're tied more closely with inflation in general, other components. It's impacted by other components of monetary policy, like the size of the balance sheet at the Fed. So I think what we tend to focus on is just the federal funds rate.
Right.
And I think there's been a realization that, within real estate, within mortgage lending, it is on the longer part of the curve, not the overnight, 1 day, 2 second rate. And to your point, I mean, I think if you kind of take a sampling of different economists and outsources, you'll see that, it probably averages around the expectation by the end of 2025 would be in the low sixes, low to mid sixes on the 30-year rate, depending on, where you are as a consumer qualifying for a mortgage today. That's between 6.5 and north of 7. So probably, 25 to 50 bips. So a little bit. Today, we heard from Jerome Powell yesterday on the 25 basis point cut that, there's some softness, right? And definitely set kind of a tone and an expectation for walking down the stairs on rates carefully, slowly. So I think it's kind of, again, it's coming to a realization on a longer term forecast for rates.
Yeah, and I think the interest rates is such a fascinating topic. And when I'm out in the market talking to real estate investors, I find that a lot of people, and not in a negative way, don't really understand how the rate that they hear on CNBC and they hear Jerome Powell talking about, how that doesn't directly impact the pricing of their loans. And, it might be a whole other episode that we could sit down and really break down how that works, because, I think it's different than a lot of people think. But we can save that for another time, because I think that's a whole conversation in and of itself. But, I think if we start looking forward, right, you started talking a little bit about kind of how you expect rates to maybe move over the next year. There's a lot of factors that are important in what that ultimate rate ends up being for the borrower community. There's a number of things I think that people should be thinking about, right? And it's not just what the Federal Reserve is doing. There's a lot of factors. Obviously, big story of 2024, which took up a lot of our, mental bandwidth, I feel like, was the presidential election.
That was fun.
Yeah, it was something. But I think there was a lot of consideration over kind of what. And I think there should be a lot of consideration going forward over what some of the new administration's policies are going to do and how that's going to impact our customer. Let's talk a little bit about that and how you see the new administration kind of playing into the business of speculative real estate investment.
Yeah. So that's a really good question. So, if I kind of go back to what I said on 2024, taking it a more simplistic approach, I feel like that should continue in the mindset of 2025. Rates will remain a bit elevated now. Historically, no, but in the last 10 years, yes. And when you look at the new administration coming in and some of the posturing, at least, of what that side of the house is planning on doing. The two areas of focus that I think the community is talking about the most really are tariffs, right? How do tariffs impact trade, and then ultimately prices on raw materials like wood or other types of products that our community regularly relies on. And the other one is just labor, right? A lot of conversation about deportations and what does that mean, timeline, how, where. And, I think time will tell in terms of which of these are what I'd call, more real in terms of actual policies versus kind of some political posturing, right? Prior to getting in the seat in January. So with all of that going on in the political stratosphere, that's why I say just more blocking and tackling, the better. What do I mean by that is if you're looking at a deal and the profit margin doesn't really withstand, a material increase in wood or raw material prices, or, the human capital cost of your business, is a component you think may change. Stress those out. Think about those things when you're looking at new opportunities, and make sure that there's enough margin on that product on the background. The other thing I'd say too is when you look at scale, when you have something that's an input cost to your business change rapidly, in which it could, the more projects you have that are well underwritten by you, you feel confident about, the better. The more projects you have outstanding and you don't have as good of a read on each individual one, always remember that like those costs will equally impact all of your projects for the most part. So if you have 50 thin margin deals or 10 better margin deals, that's some of the math that, from a risk perspective, you might want to think about and play around within your business.
Yeah, I think that's a great point. And,
Yep.
and I think Renovo as a relationship lender, I think one of the things that's really important too to think about for any real estate investor in their business is picking great partners, right? And I know here we are not a transactional lender.
No.
We are very invested in the long-term success of our client because our goal is to have long relationships with our borrowers and find ways to add value to their business. But part of that, if we're protecting the long-term relationship component, we are very invested in not allowing our clients to do deals that are not great deals for them, right? And of course, that impacts our risk appetite, et cetera. But I think finding partners that really are going to put your interests in you're going to focus on your interests and not just try to close a loan because you want to close the deal, but really working with you to make sure that that's a deal that's not going to blow up on you. And I think that's, whether Renovo is your lender or someone else, but being very thoughtful about who you work with and making sure that those interests are aligned. Something we do a lot of.
Yeah, I can't tell you, James, like how many times, myself, folks on my team, we've hopped on with clients and the LO at times and talked to them about what they're looking at. I know our LOs do that every single day. And it's important, to have a lender, whether it's Renovo or another one that you feel is a partner with you. Sometimes the best deal is one you don't do.
Absolutely.
And it keeps you around, keeps you moving. And, some of the basic things that you can work on with us, for example, is comping out the deals. What do you think the value is? What do you think our LO thinks the value is? And talking about those things. How quickly do you think you can do it? What is your budget, right? What GC are you using? Are you the GC? All of those things are so critically important to make sure we're on the same page. And, Renovo is not a trade. We're a long-term business that wants to have a relationship with you.
I think that's a really important point. And to your point from a moment ago, right? Like helping stress the deal a little bit as well,
Yeah.
right? Because we could see. I mean, listen, I think a lot of people believe that a lot of the things that are coming out of the upcoming or the incoming administration, a lot of the things that are being said, a lot of people are kind of taking or not taking at face value.
Yeah,
Right?
for sure.
They are discounting a lot of that talk as posturing
Yeah. It's
or
not
just
real, right?
yeah,
Can't be
yeah.
real.
There's no way they'll actually do that.
Yeah.
They might.
Yep.
Totally might. Right.
Yep.
And so I think, realizing and taking that very seriously and making sure that you're protecting yourself. I think there are environments when, the real estate market gives you the opportunity to really run.
Oh yeah.
And then there are times when you need to be a little bit more cautious. You need to be thinking about things from how do I manage the potential downside risk?
Yep.
And I think this is a time that, for that, right? And I think that's an important thing for our customers to think or to be thinking about is how do I manage some of these things? Because they very well could happen. And to your point, if you're running, a lot of our clients are running very large businesses. They're doing a lot of volume, and those problems can compound
Yes.
across your portfolio of projects. And so just being really mindful to not overextend, being very mindful of reserves to
Yep.
accommodate, because in this business, it doesn't take that many mistakes to actually kill you. Right. And,
Totally.
I think this is an environment where you got to make sure you're not putting yourself at risk, your whole business at risk, because
Yeah.
the reality is that most of our clients, this is their life.
Yeah.
This is the livelihood of them and everyone that depends on them. You got to make sure you take care of the house and take the opportunities to run when you can.
Yep.
But, I think this is a good time to be cautious.
Just being on the risk side, kind of more the capital market side. One thing that a lot of folks don't appreciate is, when a client is going in on a project, how much is at stake
Yeah.
for them, right? They have to put, whatever the deposit is down. They have to source materials. They have to find, if they're not the GC, they have to go find labor to work on the project, the expertise that's needed. They might have multiple going on. So the logistics around that, travel time. And really, when you think about the math, I always say this, it's money out of my wallet constantly. It doesn't come back to me until I'm done.
Yep.
And so when you look at that from the client's perspective, it is stressful, right? It's an asset-based play. And, when you're running an asset-based play, especially with all the, the kind of weather going on, you want to have more working capital. You want to have more liquidity around. Even something like a portfolio that you may have equity in it. Equity can be difficult to convert into liquidity at times, right? And you may need it faster. So, one thing to remember too is like, today, you can have liquid reserves in something like a mutual fund and earn something on it. So you're not having you're having complete drag on holding it in a checking account. There's things that you can do to think about in terms of minimizing your cost and also having more liquid reserves around. But I think at times, we don't, the overall financing community doesn't appreciate from the client perspective how much is at stake. To your point, it is the livelihood. It is what we're doing. And we have to be partners because we want to make loans. We want to help your project. We want your project to succeed. If it doesn't, it hurts you and it hurts us.
Absolutely. And I think, not to belabor this point,
Yeah.
but, really being open-minded to the feedback that you get from your lender, right? Because I know in our case, we are very invested, like I said before, in our client's success, because at the most basic level, if our borrower busts, right? If their business goes bust, there's no more loans for us to do with them, right?
Yeah.
And now that's not how we think about it, but
No.
at the very basic level, our interests are incredibly aligned in that way.
Incredibly.
But we are at the end of the day in the people business.
Yep.
And we want to support our clients and help them achieve their dreams. But sometimes there are, our clients are risk takers by nature, right? They are have a high risk appetite, higher than the average Joe for sure,
Yeah.
or they wouldn't be doing this. So every now and then, we have to be in the position to help them understand that maybe we need to tap the brakes here, or just think about this deal differently.
Yeah.
And it's not because it's a selfish thing for us. We're not just trying to tell you no.
Yeah.
We're trying to help you find how it makes sense to, a way to do the deal, that's going to keep you out of trouble so that we can maintain a long-term relationship. So
Yeah.
I think that's really important. And again, goes back to choosing your partners wisely. But we don't have to go too deep on that. I think we probably made that point, but certainly important. Let's talk a little bit more about some of the potential headwinds that we might see in 2025. I think there's a handful of things that, from a thematic standpoint, we saw in 24. There are some of those themes I think that we, can reasonably expect to continue into 25 and potentially beyond. Interest rates is certainly a big one. But I think also, in certain regions of this country, insurance is a massive concern, right? Talk to me about some of those concerns and how some of our clients that are handling those things well, what are they doing
Yeah.
to protect themselves, especially people in Florida and Texas are both in markets where I think insurance has really started to become more of a factor than it certainly was in the past.
Yeah, absolutely. So I'm glad you brought that up. Things like property taxes and insurance are at the forefront of our client experience, right? Whether you're doing a short-term loan, new construction, rehab, or more permanent financing on the DSCR side, they're critically important factors to the math on the deal. Renovo takes an approach of being a in-market lender so that we can understand, those dynamics more closely. Insurance, you mentioned Florida and you mentioned Texas. Those are two good examples, both of which have, insurance premiums that are above national averages for different reasons. Florida, obviously, hurricane risk, weather-related risk, property damage risk. Texas, there's a little bit about that, but it's also more political in nature, right? If you look at a place like Houston, property taxes are incredibly high for the Houston school district, right? That's where a majority of the funding comes from, is property taxes. So you kind of have different local policies impacting how taxes are charged. So in the case of Texas, an outsized portion of tax revenue comes from property versus, say, income taxes. As a client, you should assume that insurance is not going to go down.
Yeah.
Right? It's not.
As much as you want it to.
As much as you want. I think in Florida, you had 2 hurricanes back to back, very unexpected, and really caused, havoc within the state, within the local Tampa area community. As simple as just binding insurance has become difficult. So if you think about it, I bought a house, I rehabbed it. It's a single family, 1 story, not on stilts. I thought my insurance was going to be A. I finished the rehab. It's 5 times what A is. And in that scenario, you need more equity. So always being prepared for what could happen, especially in places like Florida where you have weather risk that could impact your deal. Insurance as an industry too is impacted a little bit by, federal policies, insuring the insurers, reinsurance, way too complicated for me.
Yeah.
But it's something that you need to always keep in mind.
Definitely.
And on the tax side, similarly, another local issue, I mentioned Texas, but taxes similarly too are likely not to go down. Taxes on new construction deals and rehab deals, a lot of times you have to think about what your post-tax burden is going to be, not what the taxes are on the current property.
Right.
So just thinking about all of those different scenarios, primarily around taxes and insurance, when you look at permanent financing on the DSCR side, aside from the debt service cost, taxes and insurance are your biggest expenses. And so we've seen either through weather events or, political policies that have changed in local markets, that they can vary quite significantly, even within a 12-month period of time when you're working on something to then hold for a longer period of time.
Yeah, and I think especially with taxes, it's important to not take what you're hearing necessarily from the news and things
Yep.
like that at face value. I think just making sure that you're stressing your model and your numbers
Mhm.
on those things, because I know, like in Texas right now, there's a lot of talk about, the current governor wants to eliminate property taxes.
Hmm.
Eliminate. Well, in Texas, we don't have state income tax. And to your point, property taxes fund a lot of the services, especially education and things of that nature.
Yep.
If they eliminate property taxes, you better believe they're getting it somewhere else.
Yes.
So if you heard that and go, oh,
Yeah.
we might have much lower property taxes, and then I can justify doing this deal that might have a pretty skinny margin on it today, but I'm betting that maybe we get some relief. I would be very cautious about those types of assumptions, because the reality is those things have to get funded somehow.
Yeah.
And it's fun from a political standpoint for people to talk about those things because everybody gets real excited. But there's something underneath that is going to come back and get you. So just be really cautious, I think, about how you are taking in that information and how much weight you give some of those more political posturing type statements. Maybe they are successful in reducing property taxes. They did reduce, I live in Texas, they did reduce our property taxes a little bit. I know there's a lot of emphasis on.
I'm living in the wrong places. I got to figure that out.
Hey, we'd love to have you in Austin. That's probably a pretty good segue actually to some of the regional talk I wanted to touch on. What are some regions that we are expecting opportunity to maybe be a little bit more advantageous for our clients? Where are some of the markets where it's a little more stress? I think Texas, and really more Austin, I think. And as a longtime resident of Austin myself, it's sometimes frustrating to hear Austin being kind of the poster child for the worst real estate market in the country. But the fact is that we have had, a little bit of a reset there, and probably correctly so. But I do think that there are some markets that are going to be a little bit more challenged. Talk to me about how you're looking at it from a regional or a local perspective that might be valuable for our client base.
Yeah. So a couple kind of notes on that. I think I always think of deal making and risk as a spectrum, right? Beyond a spectrum, I think of it in terms of duration. So when you're in a market, what type of project are you working on and how long are you going to be in it?
Mm-hmm.
So I'll give you an example since we were talking about taxes. When you're looking at term loans or DSCR loans as an investment, the thing that people always hyper focus on, especially in my world, is a DSCR, right? Is it covering your expenses? What is the rental yield to you, the customer? What's the debt yield to me as the lender? And making sure there's some minimum margin there. That is very much looked at as a point in time calculation, especially in the kind of broader single house permanent space. If I were to think about to your question about areas and what to look at, if you're going to do a number of term stabilization plays in an area, you might want to look and see how the city or the town is actually funded. If it's underfunded, you can maybe predict in a few years taxes are going to go up.
Mm-hmm.
There's certain areas in our country that are not underfunded, right? And how does that math and that outlook for your investment look? Some term folks on that strategy, they're actually okay with a lower DSCR because, they're considering their tax savings or tax benefits or the longer term hold and appreciation that they might get from the asset, less so the rental yield. So that's why I mentioned a spectrum. If you're an excellent property manager and you're vertically integrated, yes, probably doing term loans in an area that have higher yields, maybe lower property values is good for you. If property management is not your strength, but you want some appreciation, you want to build your REO, that may not be the place for you. It might be more of a regular market in a regular suburban town or city where you can get a little bit of a mix of all of those things. You get a little bit of rental carry, get a little bit of long-term, hopefully HPA carry, get the tax benefits. So again, it kind of depends a little bit on what your personal strategy is going to be on that side. Regionally on the short-term side, if you're more of a flipper or you're more of a builder, you're focused on kind of turning and realizing profit for your business that way, paying a little more attention on just in terms of what pricing is doing in your market. You mentioned Austin. Austin, sorry, poster child. But it isn't just Austin. You've seen it in places like Boise, Scottsdale, the greater Phoenix area, twice, where you have kind of larger economic and social reasons that people want to go to these areas. If you look at Austin, it's super fun, lots of great job opportunities, great climate, great place to raise kids. And so you have other kind of adjacent reasons that people may come into a place that impacts our markets. And so in a low rate environment where, building is easier, you have a lot of attraction to a certain place, you saw a run up, right? And then with rate movements and other reasons, there was a correction. In the moment, it's painful, but in the long term, it may be good. Maybe good that happened. So I would say for the short term focused clients, or you have a little bit of both, definitely paying attention to the magnitude of how prices are moving. Is it a flat line? Is it, a trickle up? Is it like a worm? Does it look like this? Is it Austin?
Yeah.
Right. And so one thing I would recommend to all of you is paying attention and looking at those things and matching it to your projects. So if it looks like this, ground up on the smaller side, rehab, great. If it looks like this for a very long period of time, or this for a very long period of time, you probably feel more comfortable actually doing all sorts of short-term products where your focus is getting the lowest basis as possible. So focusing on your buying strategy and embedding equity that way versus in the building side.
Yeah.
So on the short-term side, different regions behave differently. Here in Chicago, it looks more like this.
Mm-hmm. For those listening and not watching this, Darren's making a flat line with his hands.
Flat line. Flat line. There's a flat line, which flat line can be bad, but flat line can, in this sense, can be positive, right? Because your variability is not there, and you could focus more on buying right and building right. So.
Yeah, well, and I think you're never going to go wrong by getting better at buying, right?
Absolutely.
And finding ways to buy deeper. There's a lot of people that, are implementing direct to seller strategies, right? Because they're trying to get, property as cheap as they can to preserve as much potential upside. And, so I think you can never go wrong by working on that part of your business, but certainly in some markets, it's more important than in others. Obviously there's been some, we're talking about some of the challenges right now, but I think flipping it on its head and talking about the fundamentals, right? And I think that's important to understand the fundamentals in any market. Again, we talked about Austin, and the underlying fundamentals of that market are extremely strong. The job growth is crazy. There's tons of job growth, and it's a very attractive place to start companies, to relocate for quality of life and for employee
and policies. There's less red tape to get into building. Versus other parts of the country.
So the fundamentals are very strong. We're having a correction currently, but if you look at that, and project it forward, that's likely there's days on market are up, and this is obviously a tough season. This is we're kind of in the dead season for buying homes for consumers for sure. But you have to imagine if those trends hold, which I don't see a reason why they wouldn't, with the very stable, the stability of the job market there, really anchored by the state government and the University of Texas.
Yep.
You just have there's a good story there and a lot of opportunity if you know where to look, but you do have to buy right. And you've
Yes.
got to make sure that you're protecting yourself against any potential continuance of some of the downtrend in pricing.
Yep.
So just being really good on the buy is super important. Nationally, though, the supply demand imbalance for single family homes it's glaring, right?
Yes. Yes, it is.
And I think there is no national, federal policy that is going to solve that problem in any short period of time. It is in many ways a local municipality problem.
Yes.
That there's a lot of red tape, in various municipalities on building. And until that gets resolved, which is a very sticky problem and not one that will be easily solved, you're going to continue to see a pretty severe imbalance. And then it's just a matter of understanding your strategy between holding and, exactly how you want to play it. But I do think that that's, should be very positive news for our client base
Yep.
who is trying to convert, underutilized housing into, housing that is, that is up to par and people want to live in.
Yep.
So I think broadly speaking, we can sit here and be very optimistic, I think, about the market, as a whole. And then I think it's just really understanding your local market that makes the biggest difference in terms of success for your business.
Yeah. And on the positive note, right, some of the greatest buying opportunities come after a bad day,
Definitely.
right? If everything was happy all the time and then opportunities wouldn't exist, right? You need a little bit of that roller coaster
Yeah.
to find some of the opportunities. Diamonds are not found, in a beautiful garden. They're found like in the dirt, right?
That's right.
And that's something to note on the positive side, right? Like that value creation and opportunities to create value come from imbalanced times. One other thing I would note too, you mentioned housing supply and, alluding to kind of one of the themes over the last couple of years has been a shortage of housing supply. I'll turn that a little bit, maybe not upside down, but sideways, in terms of how you as a client can think about projects that you may do in a different way, which is looking at two different things, which is one, in your local market, what does the housing supply look like? Tampa, for example, parts of Florida look totally different from Chicago. Charlotte, the Queen City, love it, used to live there. Lots of ground up construction, lots of supply coming on, especially for single family rental, completely different from Boston, right? So every market's different in terms of what their housing supply looks like. And I think what you'll find is that even within each market, you'll have constrained supply or a surplus of supply at different price points.
Yes.
And, one of the themes that has come out in the end of 2024, probably in 2025, is that there is, in a lot of cases, not all, pretty good supply in the higher price point area, which makes sense because we want to be building projects that make us money. And there's constrained supply in the more affordable band. And, when you think about the projects that you're doing, some things, if you're more of a resi client, you could borrow and steal some concepts from multifamily land, like absorption, which is more of a rental concept, but it applies to selling. If I build this, is someone going to be there to buy it? I hope so.
Right.
Right. And that's stuff you can research. You can find out how many people are moving to Austin. How many, where do they work? What's the average W-2, for example, in this zip code that I'm operating in? And am I building something that somebody wants?
Yep.
Right. And so it's kind of like you want to make sure your basis in the beginning is right. And you kind of have an idea that someone's going to be there at the end to take it out where you think it's going to be. And kind of think about the projects you're doing from that angle as well.
Yeah.
is the kind of stealing a little bit of that concept and thinking about absorption and who's going to be there to take me out, who's going to pay me off. Because ultimately, the situation you don't want to be in is building something amazing or rehabbing something amazing and it's beautiful. And you're in a situation you don't understand why someone's not coming to buy it. And it could be because it's too nice.
Right.
Right. And so that's another piece of advice I'd give going into 2025 that's very regionalized.
Yeah. And people, I think, sometimes make the mistake. They build the house that they want,
Yeah,
but
sure,
they're not
totally.
building the house that everybody who's buying.
Don't tell me you're going to move in the house. I was gonna, don't want to say that, but
No. Well, but like it's natural, right?
it's natural.
You're designing
Yeah, of course.
something and you design something that you would want to live in.
Yeah.
That's not always what's going to sell the best.
Correct.
So that sounds basic, but I think it is important.
It's so true. It's very true. Design elements, that's another thing is, you mentioned it, creating something that's habitable, comfortable, nice, desirable, structurally sound, very important, very unique design elements, tend to bring in, higher value, higher luxury type properties to bear. But for the majority of projects, you're thinking about the widest audience possible that will like your product.
Yeah, the buyer pool, right? You want the biggest
maximize your buyer
pool.
Yep.
And certainly there are people that do really well in the luxury segment, but they really understand it, and that's their thing.
That's their thing. Yep.
And that, so it's not to say that stuff can't be done well, but I do think
for sure,
you're right. You absolutely take the risk that you're going to shrink your buyer pool such that you could have a harder time at the exit. And so just being aware of those things. As we kind of wrap this up, and this has been a great conversation, I wanted to end on some positive notes. And I was just kind of thinking here as we've been talking that, especially around some of the tariff conversation, right? For our flippers in the audience, if that does come to bear, certainly it will increase the costs of the inputs in their projects, but it's going to disproportionately, I would think, impact the builders. And right now, the builders are the ones supplying they're the ones adding to the supply for like, if you look at where the new supply of homes is coming from, it is overwhelmingly coming from builders.
Sure.
If the cost of lumber shoots up, it's going to hurt our flippers, but it's really going to hurt the builders. And you would expect to see a pullback in deliveries on the builder side, which will leave more opportunity for the flippers that are taking existing structure and then just bringing it up to date. And so, I think that's something to be thoughtful of as well, right? It might hurt, but it also might increase your buyer pool and create a little bit more demand for your flip projects. And so I think, always important to kind of look at all these things together. But I think there could be some positive, threads here for some of our clients on that end. And then, of course, on the multifamily side, which, we do quite a bit of multifamily lending, smaller to mid-sized multifamily, there was a lot of supply of multifamily that's been delivered over the last few years. There is not a lot in the pipeline. And so, you will see in a couple of years, if we don't get more projects in the pipeline, that, I think you're going to have more room for rent growth and things like that, because the supply demand is going to be a little bit off. We see that in the building sector all the time, specifically after '08, the builders pulled out, and then that created this huge gap where we just weren't producing enough new housing for years. And that has created this situation that we are in today, which of course was then, accentuated by COVID and the things that, the ways that changed the market. But, I think there's a lot of silver linings here, but the theme that I've kind of come away with is you got to be really sharp this year. I think you really need to stress your deals. You need to make sure that you're appropriately evaluating risk, being open to having a little more cash in your deal, keeping some additional reserves that you might not be used to. You might do fewer projects next year, but doing profitable projects and keeping yourself out of the challenged ones that really distract you from building your business over the long term, I think is something that's worth considering.
Yeah.
And again, it's going to be regional and specific to certain people, but I think those are some of my takeaways. Any parting thoughts for the audience from your seat?
Yeah, there's so many opportunities, right? If you think about some of the largest we're in the largest economy in the world, and real estate is one of the largest sections of that, right? And, even with some of the headwinds we've talked about, there's so many opportunities. It's an inefficient market. And again, the fact that it's inefficient means there's opportunity. And, the tariff thing that you mentioned, picture two magnets, pushing each other away. It creates opportunity. And on the multifamily side, on a positive note, a lot of the challenges that have been felt on multifamily are really math in nature, hitting DSCRs and rates and where they are. If you think about where we are today, if you were to look at a new multifamily deal, yeah, I think generally the consensus is we're going to be around the same, maybe a little bit lower over the next 12 months. You'd never know exactly. But you kind of know if you're going to step into a new deal today, you kind of know, yeah, I think with greater predictability, what that base is going to look like than over any time over the last 3 years.
Yeah, that's a great point.
And so, there is positives that are around, and, there is plenty of opportunity to look at. And, on the partnership side, the availability of capital, not just with ourselves, but with our competitors, the whole industry is strong. And, we strive to do better for our clients, and hopefully, going into 2025, that unlocks better experiences as partners that will help you find the next good deal.
I'm glad you mentioned that, because that's kind of one of the thoughts I wanted to close with too, right? Like, we've got a lot of money to lend. And I think that the lenders in the market that have done a good job of navigating the challenges over the last few years, and there are certainly some that have struggled, right, for various reasons, but the ones that have really performed well, there is no shortage of capital that is looking for a home in this strategy or in this sector. And
absolutely,
I know Renovo, we are sitting here, we are very excited about the upcoming, couple of years, because I think
this is U.S. real estate, guys. Come on, there's nothing better.
Yeah, and picking the right partners that are well capitalized and are prepared to help you through those challenges is super important. But we've got a ton of capital to lend, and we're really excited about working with our clients to help them continue to build their dreams. So
absolutely,
excited about what's coming, and certainly excited about where our clients are headed this year. So really appreciate your time. I think this has been a great conversation. I'd love to do it again sometime. So
let's do it. I'll bring my mug next time.
There you go.
It's over there.
There you go. No worries. We'll make sure we get the mug in the shot next time. But really appreciate your time. This has been awesome, and we look forward to doing it again soon.
All right. Thanks, James.
All right. Thanks, everybody.
Bye.